Hello everyone, this is Larry, your instructor for financial accounting. I'm going to run through with you a very fast example applying debits and credits. Specifically, we want to show you a sequence of transactions to let you see how these transactions are recorded to the journal and posted to the ledger. Again, I'll be doing this very quickly, but you have the option, watching it on a video, to stop, restart the video, and also go back and watch sections of it again. The other thing I'd like to ask, before you go any further with this video, make sure that in the financial accounting textbook, or your notes, or in the online materials that we've provided, that you please review the standard rules for debiting and crediting that show when you debit a specific type of account and credit a specific type of account. Those rules are very important, and if you're not familiar with them, you won't really understand the example that I'm about to show you very quickly. So let's take a look now at a new business that we've started up, and I have a sequence of transactions here. Let's look at the first transaction. On April 1st, investors provided $10,000 in cash to start the new business, and the business issued common stock to the investment. So cash went up for the business by $10,000, and also common stock went up. Equity was issued. Let's see what that looks like in our journal. The first journal entry shows that we have, because cash has increased, we have debited cash for the $10,000 and credited common stock for $10,000. And note the standard here that we use. We always list the debit before the credit, and we've indented the credit a little bit. Does everyone see how we've done that? You can do that in Word or Excel. Push that credit to the right. It will be easier on your eye so that you'll be able to see which account is debited and which is credited. So that's the very first entry. That was the journal entry. Now let's go back to our next transaction. The second transaction shows that on April 2nd, the business borrowed $20,000 from the bank to support its initial operations. So cash went up in the business by $20,000, but we've also incurred a liability. And here's how we recorded that. We have debited cash for $20,000. The cash went up. And we've also increased a liability called notes payable. We've increased that. It's gone up by $20,000. It is credited according to the rules of how we do debits and credits. Let's see what came next. On the 3rd of April, we purchased $5,000 of equipment for cash. So the asset called equipment went up by $5,000 and cash went down by $5,000. And here's the entry. The journal entry shows we have debited equipment for $5,000 and credited cash for $5,000. The next entry shows that also on the 3rd of April, we have purchased $2,000 of supplies on account. Note that's not with cash. Cash is not going out of our pocket today, so cash is not going down. This is on account. Supplies, the asset, are going up by $2,000, and we are incurring a liability. We're going to increase or credit our accounts receivable our accounts payable. That's very important. You need to keep those two separate. This is accounts payable because we owe that money. It is not a receivable to us. That is a payable. We owe that. So we're debiting supplies by $2,000, and we are crediting our accounts payable by $2,000. That is a liability that has gone up by $2,000. We are crediting the payable. We have increased the liability. It's very important to keep receivables and payables distinct in your mind. Two different things. Next, on the 5th, our company performs services for client number 1, and we received payment immediately of $7,000. Well, we got cash then, $7,000, and there's the entry on the 5th. We debited our cash by $7,000. It went up, and notice that we have credited the revenue account. In this case, we've called it service revenue. If we were in the business of selling goods, we might have called that account sales revenue, but we have credited our service revenue account $7,000. When we deliver goods or we do work for people, we have earned that money. We credit revenue. We've credited service revenue $7,000. What happened next? It looks like we performed $8,000 worth of services for another client, but this was on account. And we then sent them an invoice. So we didn't receive any cash yet, but we did the work for these people. So what will we be debiting? Well, we didn't receive cash, but we have a receivable. This is money that will be coming to us. So we've debited our accounts receivable, that's an asset, by $8,000. And again, we are crediting service revenue by this $8,000 because we have earned that money. We haven't received the cash yet, but we've earned that money. So we've credited service revenue for $8,000. What happened next? On the 17th, it looks like we paid $1,200 toward our account balance for those supplies we purchased earlier. Do you remember we purchased $2,000 worth of supplies? Well, we're making a payment toward that today of $1,200. That means cash is going down, so cash will be credited, and we are reducing our accounts payable. And here's the entry. We are debiting accounts payable this time because we are reducing the liability, reducing the payable, and we are crediting cash because cash is going down. What happened next? On the 20th, we purchased a small storage building for $4,000. We paid $1,000 cash down, and we signed a note for the remainder. So let's see how we entered that. Debited the building, because buildings go up. The building asset went up by $4,000. We credited cash. Cash went down by $1,000, and we incurred $3,000 more worth of debt. We have credited the notes payable for $3,000. Let's see what happened next. On the 25th of April, we paid a $250 utility bill. Well, when we have an expense like that, we will debit the expense. That's the rule. Debit the utility expense for $250, credit cash for $250. What happened next? It looks like that client that we did work for earlier in the month, who didn't pay us at the time, is now making a partial payment. We received a partial payment of $5,000 from that client for service that we already performed and billed for. That's $5,000 out of the $8,000 that were owed. Well, we'll take it. And here we are on the 28th. We received that money. We are debiting our cash by $5,000, and we are crediting accounts receivable by $5,000. It's reduced. Next, on the 30th, it looks like our company paid $1,500 in monthly rent for office space. So we debit rent expense and credit cash for the $1,500. And finally, the last item we're going to look at in the sequence, our company declared and paid a cash dividend of $3,000 to the owners. So on the 30th, for that item, we see that we are debiting dividends and crediting cash. Folks, that came at you very rapidly. That is entering or recording items into the journal. Similarly, here's the ledger with T accounts. Every item that we debited and credited in the journal similarly is debited and credited in the T accounts right here. The same numbers, it's just a nice pictorial view looking at the T accounts here. And from here, we will produce another video that you can watch next that shows us how we will run these balances and put them through a trial balance.